Perfect.
Glenn, welcome back.
Hello, Olga. How are you?
Doing
It's been
good.
such a long time.
Well, our next conversation that we're having today is just talking about buying. Someone who wants to buy a house, what to look for, what to know, when to start. So just tell us a little bit about yourself, how long you've been in the business, and then we'll jump in.
Sure. I'm Glenn Davis. I am with Benchmark Lending, and I have been in the business since 1998. I've been licensed in both New York, Pennsylvania, New Jersey, and Florida. I'm currently licensed in Pennsylvania and New Jersey. I am a licensed mortgage banker, and I love what I do, and I still have all my hair, and I'm in the real estate business. So how about that?
So do I. So that's a good sign.
So
All
there
right.
you
Well,
go.
let's jump right in. What I wanted
Sure.
to talk about today is just some of the misconceptions and things that I see when I'm working with my clients. So let's start from the beginning. Someone wants to buy a house, right? And when do you think is the best time to start planning, right? They're thinking, so, well, we want to become a homeowner one day. So when would be a good time to kind of get things figured out?
I would say as soon as possible. If you're a renter, if you are maybe still living with your parents, if you're a new couple that's renting, it's always great to do what I call establish a baseline as to where you're at financially, right?
Okay.
So we all have what I believe is, a financial fingerprint. No one's financials are exactly the same, just like our fingerprints. Regardless of where you're at in that process, whether you're thinking about buying next year or you're thinking about buying 6 months from now, I think it's really important to find out where you're at financially and what you're able to secure and afford financially. So the answer to that question is, when is a good time to start figuring out, what you can do? It's before you start looking on Zillow. How's that? Right?
That is true.
It's to figure out what you can afford before you go out looking at what you want to buy, because oftentimes that could be two very different pictures.
So how do we do that? Like, I
we
know nothing. What do we do?
Yeah, I mean, I would say contact contact me, contact your local mortgage guy, and literally have a credit report run. Figure out how much you have in savings in your 401k and your IRAs, how much you're making annually. And we can put those numbers together and give you a baseline as to where you're at and what you can afford. If that meets or exceeds what you want, then fantastic. We're in a great spot and you can buy now, or you can buy 6 months or a year from now. If you're not in that spot and maybe you've got some credit issues, maybe you've got the income, but you don't have the assets right now. We can at least guide you and walk you through what steps need to be taken so that you can go out and look for a home and, socially stalk the house that you love because you saw a nice picture of it. So that's the stuff that you want to do beforehand. All too often, I'm sure you experience this as well. You get the phone call, we just saw a house, we love it, we want to go see it. And they don't even know if they can afford it.
Absolutely.
So we really press hard and push back a little bit when folks call with that question to say, hey, before we go to step 2 or plan B, let's take care of step 1 and plan A, which is look at your financial fingerprint and see what you can actually afford. I know you work similar to the way that I work, and that is we don't want to make people house rich and cash poor. We want to make sure that you can afford the house and that you can still continue to live and go out on Friday night and go on vacations with your family.
Mm-hmm.
That's an important part of it. When I talk to my clients, and I say this, and it's probably going to sound scripted, not because it is, but because I've said it so many times.
Yeah.
And that is, I go against the grain in the world of lending. I do not want you spending 35% or 40% of your pre-tax monthly dollar on a house. It just doesn't make sense. You should spend somewhere around 25% of that.
Okay.
And that's your debt to income ratio. And the debt to income ratio, for those of you that don't know, it's nothing more than your housing payment divided by your monthly income, pre-tax dollar.
Right.
And then your back ratio, or your back debt to income ratio, is your housing payment plus your car payment, your student loans, and your credit cards. In the world of lending, they think you should spend 35% of your pre-tax dollars on a housing payment and up to 50% with everything else. I just don't think that's the right thing to do for borrowers. Again,
Let
we
me
all
ask
have
you,
our,
yeah, let me ask you about a question about that debt to income ratio, because I really want people to understand what that means. Say we're shooting for 25% because that is allowing you some breathing room in the income that you bring in and then versus your biggest payment, which is your housing payment. Why is it that the ratio is calculated with pre-tax versus how much you actually bring home? Because that to most people, that is the most relevant number, is what your take home pay is.
I'd like to tell you I knew the answer to why they do it that way. I don't. I'm not going to tell
Okay.
you I'm that smart. I'm just going to tell you that I am a consumer, just as you are, and just as everyone who's watching this is. And I like to do things. I like to go on vacation. I like red wine and a really good steak.
Sure.
We all have our things that we like and that we want to do and that we want to continue to do. And that kind of folds back to that not making a house rich and cash poor. That's not what it's all about.
So when I teach my workshops for buyers and we go over everything from start to finish, the way I try to explain to them and make it simple is that, think of the buying process as A to Z, right? And if you are looking at houses online on Zillow, or you're actually going to open houses, that's like letter M in the alphabet. And everything in the beginning that you're supposed to do to make sure that you are ready to go and look at that house and actually make an offer, you haven't done that yet. So talking to a lender, and by the way, I think it's important for people to know that it doesn't cost them anything to do that, right? You have the conversation, the credit gets pulled for free, and its initial consultation, it doesn't cost them anything to get started in that process.
Absolutely not.
People think, oh my God, I'm going to have to pay all this money, so I'm just going to look at houses first, which is really completely backwards thinking. And when you were talking about house rich and everything else poor, when I talk to clients is instead of telling them that you can be pre-approved for $500,000, which to them is like, wow, I can get a mansion. I always ask them, what are you comfortable paying per month right now based on where you live? And I want you to focus on that monthly payment, not on what you can afford. But again, I want you to be able to go on vacations and eat out and have fun as well. So that's what I kind of stress on.
So that's why you and I work so well together, because I asked the same question. And surprisingly enough, part of what I do is ask, have you created a budget? And I'm going to tell you that 80% of the time that answer is no. And that's okay. We're not, that's not taught in our society. A budget is a bad word, and it's actually not. So it does come down to, what are you comfortable with spending on a housing payment on a monthly basis? And if someone tells me $2,000, then we need to go and have the conversation about, okay, $2,000, where are we buying the house? Are we buying it in New Jersey or Pennsylvania? If you're buying it in New Jersey, what you need to realize is that probably a third of that payment is going to be your property taxes, if not more, depending on where you're buying a house.
Right.
So all part of the conversation and all part of that going from A to Z. But it's truly the most important part because it tees you up for being able to purchase that dream home or the first home or whatever it might be. Maybe I have my nephew right now looking for a condo, and I just had this conversation with him at the beginning of the week. It's his first house out of school, doesn't have a car payment yet, doesn't really have any bills. My brother hasn't kicked him out of the house yet, which that's going to happen soon. But he needs to factor in all those fees because his car is 8 years old or however old it is, and he's going to need a new one. So rather than put himself in a position where he's spending, and I think we were working with $1,500 a month for a housing payment,
Right.
So what we determined out of that 20-minute conversation and out of running his credit and having him kind of complete our little online application, which takes about 6 minutes, we determined that the best thing for him to do was to wait, save, and next year, this time we'll be looking for a house. But he'll be looking for a house. He'll be completely qualified at that point. He'll have money in the bank, and he'll still be able to do everything he wants to do that he does now as a 24-year-old in today's world.
Right. So you mentioned that when the original conversation takes place with someone who's thinking about buying, one of the things you do is you pull the credit. And let's say there's issues on that credit. I think people don't realize how long, and I learned something new in the last few months with you having this conversation between you and the credit repair girl that I work with, that people don't realize how some little mistakes and honest mistakes sometimes with their credit, how long it can take to fix those things. Can you talk a little bit about that, just so people understand that
Yeah,
sometimes and why?
absolutely. So I will preference this with I am not the credit guy.
Yes.
And
Yes.
I will tell you what I'm going to tell you is based off of my experience, and that is, the all too often I hear, well, I was back in college and didn't care at the time, or my wife did it, or my husband was supposed to pay it and we just forgot. So those things happen. Listen, we all live, we're all human.
Right.
To miss a payment once, twice is not the end of the world. Um, to forget about it and not pay anything in your high school years, and then as you approach the time when you want to buy a house, that's when we need to address that decision. Right, wrong, or indifferent, it's the decision that you made, and it's now following you into the future, and it will continue to do so unless you address it. Those things can be resolved in a short period of time, depending on what it is. When I say a short period of time, 2 to 3 months, or it can take 6 months, 8 months, up to a year to get that stuff flushed out of your credit report.
Right.
None of that is bad news, by the way, because there is a solution to the problem, and I think that's the bigger point here. If you've had dinged up credit, if you've made decisions that weren't in your favor, by the way, I'm saying that because I don't want to call them a poor decision and hurt anyone's feelings, but you know what I mean. We've all been there, right? We've all done it. It can be repaired. It can be fixed. It's not going to be the immediate gratification that we maybe want, but at least, again, going back to that term that I used before, we have a baseline of where we're at, and we have an action plan to take us to where we need to be. And that's one of the important things that I say to people when they're coming to me and they're saying, we don't know if we're ready to buy yet, or we don't know if this is the right time. It's kind of like having kids. There never is a right time to buy a house. I don't care where rates are at or where the market's at. There's never a right time. The time is when you do it, and that is what it is. So that being said, if you're not ready to buy now but want to buy in the future, let's establish that baseline now so that we know we have a game plan to move forward, and we have a game plan to get you in the house where you're not, again, house rich and cash poor. You're not struggling, but you're in a comfortable position and you can actually enjoy the house.
Can you give some examples of what can people do with their credit that will drastically make someone ineligible to buy a house? Like, what are some of the basic credit mistakes that you see people make that they really should?
So for current homeowners, the biggest ding that you can have in your credit is to miss a mortgage payment.
Okay.
Or a home equity line payment, plus they're both viewed the same.
Okay.
If you don't have a house, the car payment, the credit cards, they are also things that need to be watched and addressed and paid. If they're not, they can certainly have an impact on your credit score that's going to be negative. Student loans. A lot of times we have people that they've just stopped paying student loans because of whatever the situation might be. There are all items that are going to negatively impact you when it comes to buying a house, and negatively impact you in your credit scores. How deep that cut is, that really is kind of determined by how long you've not made the payment or how many times you've missed the payment. So I don't want to go down that road or drill down on that, but there is a negative impact for that stuff. Again, the flip side of the coin and the optimist in me is there's a plan, there's a way to get out. There's a way to resolve that. There's a way to correct it. And again, it's not going to be that if you have something today, you're going to be able to buy a house in January. But maybe if we address it today, you'll be able to buy a house next November. So that's the plan there.
So you're talking about missing payments, and also that being late on your payments falls in the same category, right? That really can
Correct.
make your score drop as well.
Correct. We have some of the common ones, and again, we're all human. We all make mistakes, but maybe we'll have the husband forget to make a payment on his, and just maybe they were on vacation, whatever it might be. Forget to make a payment on his camper or his boat or his quad, or maybe we have the wife who missed a payment with white and black.
Postcard.
Yeah, there you go. So one of these stores out there, or we have a partner who's forgotten to make a payment on something. We're human, right? I mean, it happens. If it happens once, it's not the end of the world. If it happens twice, it's not the end of the world. If it's a consistent problem, that's where we've got to address it and kind of change the direction of that ship and point it in a direction where you are making payments on time and we're addressing the missed payments.
Gotcha. Talk to me a little bit about, I hear people all the time, they don't realize that the actual cost, what are the costs of buying a house? What's important to know for buyers?
So the cost of buying a house, and I'm assuming you're speaking of the closing costs.
Right, people realize, they're like, oh, well, I have money for down payment, but what they don't realize that there's a cost to buying a house. Like how,
There is a cost of buying a house.
right? How much are we budgeting roughly? Is there some kind of a percentage or a number that you can suggest to people?
I don't necessarily know that it's a percentage. And again, I say that only because of the taxes in New Jersey. And, you know,
Sure.
I'll lay out this plan for you. If you're buying a $350,000 house or a $300,000 house in New Jersey, you can expect your closing cost to be somewhere between that $10,000 and $13,000 range, right? That's your attorney, that's your title insurance, that's your home inspections, that's your recording fees, your bank, your escrows, your homeowner's insurance, your taxes. Let's move that same exact house, that $300,000 to $350,000 house to Pennsylvania, and you're probably looking somewhere around 16 to 18,000. And that's a little overinflated, but I did that for a reason. So when you purchase a home in Pennsylvania, while yes, taxes might be cheaper, Pennsylvania charges you 1% for the purchase of a home. So if you're buying a $350,000 house, you already automatically have $3,500 that's being tacked on. Taxes in Pennsylvania, property taxes are paid annually. So when you're closing on a home in Pennsylvania compared to New Jersey where they're paid quarterly, typically you're reimbursing the seller whatever number of months, and you're coming to the closing table with almost a full year, if not a full year's worth of property taxes. So you know, when you talk about a percentage, I don't know, let's take a quick look and see what percent of $12,000 is of 3,500, and you know, say 3%.
So it's
as a worst case.
So it's important for buyers to understand that depending on where they buy, their closing costs are going to vary.
Correct.
And I always tell them that you really need to budget, you know, your down payment plus probably
an additional 2 to 3%.
5. Well, I actually go higher. I go between 2%.
Yep.
What I suggest, because I always tell them I'm going to give you worst case scenario, and then most likely these figures are going to be less, but at least they're not shocked when the real figures come into the
Correct. Correct.
All right. So let's dispel the myth of having to have a lot of money in the bank in order to buy a home. A lot of people think that they need to have 20% down.
Well, that's just a myth now, isn't it?
Yes, it is. So let's dive into that and digest that.
Yeah, one of the again, the myths out there is that, oh, you need to have X number of dollars down, and although you hit the nail on the head with that one. You know, we live in a time where, and again, the person with perfect credit just getting out of school, or maybe the person who's got a great job and has perfect credit, you can still put down as little as 3% conventionally.
Yep.
You know, FHA, you can put down 3.5%. USDA, you can put down 0%.
Yes.
You know, VA, you can put down 0%. Some of the things that we hear often, some of the questions that I get from a lot of my borrowers are, or my clients are, you know, can we build the closing cost into the loan?
Okay.
That's a myth. You know, the fact is you don't really build the closing cost into the loan. The fact is you're either getting a seller credit at the closing table or a seller and a lender credit, and vice versa. But you've got to put down X number of dollars. You've got to have some skin in the game.
Sure.
So, but yeah, the myth, you know, whether it's 3%, 5%, 10%, 15%, you're able to buy a home for, I don't want to say nothing, but close to nothing down. 3% is pretty minimal when you're looking at the big picture of buying, let's say, a $300,000 house.
Is that true, though, that in order for you to have the privilege, and that's how I look at it, is for you to have the privilege of only putting down 3%, your financial baseline, or what I call it financial health, has to be in tip-top shape?
Great question. You thought about that. No, it's not. To answer that question. So FHA, which is a great vehicle,
Mhm.
you can have what we'll call maybe not the best of credit. FHA in the past, prior to the world we're living in right now, we'd go down to 580. Right now we're at 620. You can
Okay.
have a credit score of 620 with 3.5% down. You can have the seller's credit you back 6% towards closing costs,
Mhm.
and you're in a house. So no, you don't need to be the perfect, outstanding financial citizen to, and I say that jokingly, but you don't need to have perfect credit. You don't need to have a lot of money in the bank. You need to have enough to put the down payment down.
What about conventional?
Conventional, you can do 3%. We can do lower credit scores into the mid 600s. We can go further with that. But when you start to go down, it kind of pushes us into that lane of FHA only because the rates seem to be a little bit better.
Better.
One of the things that we haven't talked about, which I think we should at least address here or throw it out there, is mortgage insurance.
Yes, let's talk about that.
So many people have this, again, big bad image in their head, and they've got their Uncle Stan telling them mortgage insurance is a bad thing. Mortgage insurance is derived from a few different factors, and the more important ones are the credit score and the amount that you're putting down, right?
Mhm.
So in the past, we would say, "Oh my God, you've got mortgage insurance, and you've got to keep mortgage insurance for the life of the loan," and that simply isn't true anymore. That is true with FHA. Conventionally, it is not. But when you look at someone who, let's say, has a 730 credit score and they're putting down 10% on a $400,000 house, and again, I'm giving you a hypothetical here, but it's pretty darn close. Their mortgage insurance on a monthly basis is probably $80 or $90.
Mhm.
Most people in the past, that number would be much, much larger than that. But the mortgage insurance companies, much like the lending companies, uh, view things much more granularly now. So they look at your credit score, they look at how much you're putting down, they look at, there's a lot of different factors that go into it. With FHA mortgages, that mortgage insurance is there. It's the same whether you're putting down 3.5%. It does change a little bit if you put down 5%, but it's not a huge difference. But that mortgage does stay on the life of the loan. And the only way to get rid of that is to sell the house or to refinance out of it.
Mhm.
Conventionally, you've got it for 24 months. You can petition to have it removed, and it's gone. You have to have the equity in the house. Obviously, the 78% is actually the true amount.
Right.
Got to have 22% equity in the house, but it is possible to have that removed. So it's
I'm
not
a
the big ugly bear that most people, I believe, think it is.
I'm actually a fan of, and again, that's where you as a lender sit down and you do the pros and cons of weighing in. And I suggest to people that if you plan on staying in the home for a long time, consider paying your mortgage insurance up front. So that's not part of your monthly payment. What do you think about that?
I believe that's probably the best avenue to go in most cases, but the reason that they're only putting down X number of dollars is because
Mm-hmm.
they don't have enough to put the 20% down. So a lot of times they don't have the funds to come up with that upfront mortgage insurance and pay it out of pocket.
Mm-hmm.
If they do have that ability, then it's a perfect way to go. There's also lender paid mortgage insurance, which is, there's nothing free in the world. And I love hearing these advertisements on the radio and on TV, no mortgage insurance, this or that. It's being paid for somehow. And the way that it's being paid for, it's either the rate is being inflated,
Right.
in which case you're now stuck with yes, you have no mortgage insurance, but you have a rate that's maybe a quarter or 3/8 higher than what the market is bearing. And now you're stuck with that rate for the life of the loan. You can pay for it upfront. You can have it built into your monthly payments, and in some cases, you can have it actually built into the loan. So there's a multitude of factors that we can kind of determine which is going to be best for the borrower. Um,
Right.
but again, I guess my message is it's not the big ugly bear that it used to be.
Right. I think it's a great way for someone who wants to buy a house but doesn't have 20%. And that's what I always tell people. Don't think you need to have $100,000 in the bank in order to buy
Correct.
a house. You can do it with very little down or no money down. So
Correct.
what are some of your other suggestions of best ways, if you have any tips for buyers to save up for down payment and closing costs?
Best ways to save up for down payment and closing costs. So, listen, outside of this normal, let's just save, some of the things I believe that we should be taught, which maybe we're not, is how to manage our money and also how to pay down our debt. Um, you know, It's always nice to buy a home where you don't have any other debt, because I promise you, if you buy a new home, you will be at Home Depot or Lowe's or somewhere for the next 6 months every weekend, right?
That's true.
So, without having money, obviously you save money. One of the things that I do want to point out to people is, and that it's very important that you not only talk to your mortgage person about this, but that you share this with the realtor. And we do this a lot, is that if you don't have the 20% down and maybe you're tight with cash for closing costs, we can always do a seller credit.
Mm-hmm.
And, I'm going to use hypothetical numbers here, but let's say you're buying a $200,000 house and you're putting down $10,000, and the closing costs are going to be an additional $10,000. Maybe you buy the house and you tell your realtor that. So when you submit your offer, you buy the house at 210,000. The sellers credit you back $10,000, which covers your closing costs. They get their 200,000, which is the amount they want for the house, and everyone's happy. And it probably costs you maybe $45 a month more for that $10,000. So that's an option that I don't believe a lot of people look at or understand or even know is available to them. And the borrower should share that with the realtor, because that's a great way to get into a house without having a boatload in the back.
And that's a great strategy that we sometimes utilize if we can, is we bump up the sale price if the neighborhood comparables would allow it.
Exactly.
And what we also try to explain to clients, because sometimes it's hard for them to understand things in hundreds and thousands of dollars. And you gave a good example, and I use the same benchmark, is for every $10,000 more in overall purchase price, it is an extra about roughly $50,000 in your monthly, right?
$50. Yep.
$50 a month extra in your monthly payment if you have to pay an extra $10,000. Because sometimes we're negotiating and we're stuck. Seller is asking for this, but the buyer's like, well, I can't afford to be paid more than that. If we break it down to them in the manageable monthly, right? And we tell them, listen, $50 is 10 Starbucks. If you really go down that route, right? Or $50 could be a gym membership, or it's eating out, it's lunch.
Yeah.
For two. It's what it is how I break it down to people, if that's the way they kind of try to, level things. But if people need help with their down payment or closing costs, can they get gift money from who? Who can give them money?
Family member only.
Okay. No.
Define family member.
Yes, please tell me who.
Well, it's supposed to be a blood family member or some type of a marital connection. So a lot of times, listen, 99% of the time you have a child receiving a gift from a parent. Mm-hmm. And there's cases where children are now kind of gifting their parents money because maybe they're not in the best financial situation for them to get into a position. But a lot of times it's coming from an immediate family member, from a husband to a wife. Maybe we have a couple where one has credit that's impaired, but the other has a really good income and really good, but doesn't have any money. And the one with the impaired credit, they gift them the funds and they buy a house. So gifting money is always available. Again, it has to be a family member. They signed a simple gift letter, and the world's still around and moving into a house.
Is there a limit as to how much can be given, or no? No. Okay.
No limit.
Any other suggestions? Because I get this question all the time, and a couple of suggestions that I give to people is, if you have to budget and you kind of have to figure out where your money is going, and that way that's how you can save. What I have also suggested is when you get your tax refund, you open up a savings account, and that savings account is actually called My Future First Home, and you put that money there.
I like it.
So I talk to people about tax refunds. And then also, as we're heading in towards the end of the year, if you are going to be getting a raise or a bonus, you take that money, you stick to the same budget, the same style of living that you have now, but then you use that extra money that you're getting as part of your raise or a bonus.
Put it into a savings account.
Which automatically have it transferring to the
Absolutely.
Do you have any other tips and tricks that I should know about?
Yeah, I mean, tips and tricks, listen, there are a lot of folks out there that have parents who are thankfully still alive, who are retired, and maybe the buyer is in a situation where their income isn't enough to support the home that they want to buy. We have a lot of times we'll have a mother or a father go onto the mortgage as a non-occupying co-borrower.
Okay, so
And
co-sign
that's
loan. That's what you're
co-sign
referring to?
loan.
Okay.
That's a great way to get into a house. Um, we talked about USDA briefly, but USDA allows you, depending on where the home is located, zero down.
Mhm.
So that's another great way.
But
As
there's
far
income
as
limitations, right? For
there
you.
are income limitations depending on
Right.
where it's at, and that's again something you need to kind of drill down with whoever you're working with for the mortgage.
Sure. Mhm.
Um, the VA we discussed, the FHA, the 3.5% down. I mean, it really comes down to just, I had a borrower a few months back that ended up selling his motorcycle and a truck so that he can get the down payment for the house. But,
Right.
You've got to want to. That's the reality
That's
of
true.
it. It's like anything else. It's like going on a diet, quitting smoking, going to the gym. You've got to want to. And if you want a house, you've got to, there's got to be some give in order to get some take, right?
I have advised buyers in the past where they had a car payment of $800. And I asked them, like, how badly do you want to buy a home? And I said, well, you need to look at your car payment. How badly do you want this car? Because you can always either trade this in or you can sell the car. And then if you lower your debt payment, because that goes against, your debt to income ratio, you lower that payment, that gives you more flexibility, more power to be able to afford a home.
Yep.
Again, just like you said, how bad do you want it? How bad do you want it? All right.
Agreed. So, a lot of it comes down to Olga. It's literally just kind of, we started this with when do you start? There is no good time to start. The time to start is now, and start at that point and find out where that baseline is for your income, for your debt,
Sure.
for your credit, and work from there. The housing market will always be here. They'll have strong years, they'll have weak years, but the reality is we all need a roof over our head.
Absolutely. I would
So,
start as soon as you start thinking about it, because there is no too early, I think, because
there's never a too early.
you may need a year to get your finances in order to be able to buy, and then people get upset and frustrated when they realize that you cannot buy a house. And then they say, well, I wish I started this sooner. So I think the number one takeaway is start as soon as you're thinking about it.
Absolutely.
Because it doesn't cost anything to have a consultation, to speak with someone as a professional as you,
Yeah.
just to get some ideas on, here's my homework, here's what I need to do, here's a game plan, right? Because it may take time.
Start now, develop a plan, and put your goal in place and just follow through with it.
I think what I'll do is I will attach a budget worksheet, which I have a really good one, as part of the homework for this workshop. If someone actually wants to understand how much money you have coming in and what your expenses are, and we can always split the expenses in two ways: the necessary expenses for your survival, and then expenses that are more flexible and I want to have them. And, right?
There's the I need and the I want, right?
That's right. That's exactly right. Wow. And then also maybe attaching a mortgage calculator if people want to kind of get an idea, if somebody has a mortgage and they maybe want to do some kind of figuring things out, I think those will be helpful. So we'll attach them to this video. All right. Any last thoughts, last things to kind of?
My thoughts for the time period that we're in is that, for the foreseeable future, we're going to see rates remain relatively flat. Mm-hmm. Historically speaking, it's crazy low. When I got in the business, people were begging for 9%. So, that kind of gives you a little bit of indication. The housing market is healthy, I think, regardless of where you are. It's whether you're down the beach or whether you're up here I'm in Hunterdon County, or people seem to be moving from the cities out to the suburbs. And I believe that will continue for the foreseeable future as well. It's a great time to buy. It's a great time to sell. And again, if you're in a position where you don't know whether it makes sense to do one or the other, that's why we're here.
Exactly.
I can certainly talk to you about selling a home, and I can certainly talk to you about what it takes to buy a home. And if now's not the time, maybe next year is, and we can work towards that goal. So
Awesome. Well, thank you so much for sharing your wisdom with me. I learned a couple things myself, so that's always a win to me. And maybe we'll do another again in the future, but I appreciate you and you spending your time with us today.
absolutely. I appreciate you having me on.
Thank you.
Take care of it. Bye-bye.